In this video, we will be discussing consolidated financial statements after the date of acquisition. Up until this point, we've dealt only with the date of acquisition, or the date in which the parent company gains effective control of our subsidiary. On that date, we recorded the investment in S at cost on the parent's general ledger, and then we learned to do our eliminating entries to eliminate our initial investment in S against our subsidiary equity accounts, as well as any intercompany transactions. We then prepared our eliminations or consolidations worksheet in which we prepared our first balance sheet. However, after our initial acquisition date, time is still going to continue to move on, and we're going to have to deal with the fact that the company will continue to operate and the balance sheet and general ledger will change. So remember when I said you'd have to remember some stuff from the investments chapter? Sorry about that, but this is why. So during that time period between the date of acquisition and our next financial reporting date, our parent company is going to have to maintain their investment in S account using either the cost or the equity method. And whether they choose to use the cost or the equity method is going to influence the entries that they use, and therefore the eliminating entries that we are then going to need to use when we go to prepare our next set of financial statements. Now remember, when we talked about investments, I said that if a company had effective control, they could choose to use either the cost or the equity method to maintain their general ledger. The reason for this is that after our consolidation process, the resulting financial statements will be identical regardless of whether the company chose to use the cost or the equity method. Therefore, the only reason that a company might choose to use one over the other is simplicity, cost method is easier to apply, or accuracy of their standalone financial statements, as the equity method would better suit that if they need those financial statements for, say, a loan application or something like that. During the time period between the initial acquisition and our first year end, our parent company is going to record the changes to the value of the investment in S on their books as they go along. So just a reminder that under the cost method, we would only change our investment in S if there were liquidating dividends. Liquidating dividends, remember, are when a company issues dividends in excess of any retained earnings, thus taking their retained earnings negative. Under the equity method, however, we're going to treat our investment in S account as if it is a mini retained earnings account for just the parent's portion of their ownership stake. So anytime our subsidiary records dividends, that's going to decrease our investment in S as the parent. And anytime our subsidiary reports positive income, that's going to increase our investment in S as the parent. However, should our subsidiary issue a loss, that is also going to decrease our investment in S. Now, one thing I want to point out before we get too far is that your book is going to talk about both the partial equity method and the complete equity method. For the purposes of this class, we will be focusing on only the complete equity method, although I will talk about the partial equity method in passing, and we'll tell you a little bit about it as it becomes pertinent. But we're going to focus on the complete equity method because it is the more correct of the two methods. The partial equity method isn't exactly GAAP. It's kind of somewhere in the middle. It's more accurate than the cost method, but not as accurate as the complete equity method. It's easier than the complete equity method, but not as easy as the cost method. So it sort of lives somewhere in no man's land, and so it's not really the easiest and it's not really the most correct. So we're going to focus on the easy one and the most correct, and then we'll just talk about partial equity in passing. So now that we've talked about what the parent company will be doing between the date of acquisition and the first consolidated year end, let's move a little bit down our timeline and talk about what we're going to need to do to facilitate that first consolidated set of financial statements. Once we arrive at our first year end, we have a little bit more to do than we did on the date of acquisition. We will still need to eliminate our initial investment in S against our subsidiary equity accounts. We'll still need to eliminate any intercompany transactions, but we'll also need to eliminate any current year changes in investment in S. Those things that we did during the year under either the cost or the equity method. We'll also have to put together a few more financial statements than we previously did. At the date of acquisition, we only had to put together a balance sheet. But now, at our first year end, we have to also prepare an income statement, retained earnings statement, and a statement of cash flows. The reason for this is because these three statements are all covering periods of time, whereas the balance sheet is a point in time. So on the date of acquisition, no time had passed yet as a consolidated entity. But now, some time has passed since the date of acquisition. We're now at our first year end, and therefore we also have to prepare these financial statements that cover that period of time.